Alphabet just posted a massive 82% cloud growth and nearly doubled its capital spending, yet the stock paradoxically fell 3%.
Hello everyone, welcome back to AI Market News. Today we are looking at the market action for July 23, 2026. Based on available data, the biggest earnings report of the quarter so far has raised just as many questions as it answered.
Section 1. The AI Spending Paradox. Let's transition right into our first major story and examine the stunning numbers behind this quarter's most anticipated earnings report. As we can see in the chart, breaking down this phenomenal quarter reveals some truly staggering figures. Alphabet reported second quarter revenue of $119.8 billion, which is up 24% year over year. Google Cloud was the clear standout, surging 82% to $24.8 billion. Operating income also rose a healthy 30% to $40.8 billion. And according to current market information, Gemini API usage climbed to an incredible 22 billion tokens per minute.
But then we have to look at the spending side of the equation. While revenue grew 24%, Alphabet poured a massive $44.9 billion into CapEx, capital expenditure, in just this quarter alone. That roughly doubles the level from a year ago. Furthermore, estimates suggest the spending could potentially hit an astounding $257 billion by 2027.
So why does massive AI spending actually hurt the stock? Well, it all comes down to return on invested capital, or ROIC. Investors worry that this enormous CapEx cost is outpacing immediate revenue growth. When a company spends at this kind of scale, the market needs to see that each incremental dollar of investment is generating a proportional, fast return. Right now, there's a real fear that the spending is simply moving faster than the payoff. Section 2. Geopolitics push oil higher. Let's shift our focus to an entirely separate macro risk factor that intensified overnight. Looking at the sharp upward trend on this graph, WTI crude oil has broken above $90 a barrel for the very first time in this cycle. This spike comes amidst escalating tensions in the Middle East, specifically following retaliatory threats regarding power and civilian infrastructure. Why do these oil spikes matter to all of us tracking the broader market? Because sustained high energy costs directly drive up broader inflation. When energy is expensive, it costs more to transport goods and power businesses. This in turn forces central banks to keep interest rates higher for longer to cool down the economy. Section 3. Yields and market fear. Let's see how this geopolitical shock and inflation fear immediately rippled into the bond and options markets. As we can see in the chart on the left, the U.S. 10-year Treasury yield climbed to 4.679%, reflecting that exact oil-driven inflation concern. Alongside it, the VIX, the market's fear gauge, jumped over 7% to 17.84. Based on available data, this is a clear signal that options markets are pricing in meaningfully more near-term uncertainty. Section 4. U.S. equities tug of war. So how is this playing out on Wall Street? Let's observe how this dual pressure is creating a real tug of war in U.S. equity markets. Reflecting this tension, the major U.S. indices showed very muted, mixed reactions here. The Dow Jones closed down just 6 points, and the S&P 500 dipped a mere 0.14%. We are seeing markets effectively stuck in a tug of war, caught exactly between those positive AI earnings signals from tech giants and the darkening geopolitical and inflationary backdrop. Section 5. Focused on Japan markets. Let's pivot sharply now to examine what this all means for all of us tracking the Japanese markets and currency. Tracking this momentum on the graph, USDJPY is climbing above 163. Why is the dollar rising against the yen? Because as U.S. Treasury yields spike due to those inflation fears we just discussed, the dollar becomes much more attractive to yield-seeking investors. Capital naturally flows toward higher returns in the U.S., which pulls the exchange rate up. Consequently, the Nikkei 225 is now forced to navigate these intense cross-currents. The index must digest the paradox of U.S. tech earnings and the heavy pressure of a weaker yen, making it a very delicate balancing act for Japanese equities. Section 6. Upcoming economic calendar. Before we wrap up, let's look ahead to the critical economic indicators all of us should be watching next to navigate this market. Tonight, Eastern Time, we have the ECB rate decision and U.S. jobless claims. Tomorrow, Eastern Time, brings the Japan June CPI, which is a crucial input for Bank of Japan rate hike expectations, alongside the U.S. PMIs.
And looking ahead to next week, all eyes will be firmly on the U.S. Federal Reserve meeting on July 28th and 29th.
Can the promise of AI outpace the reality of its cost and global geopolitical instability? Markets have rarely had more cross-currents to navigate at once. Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.